Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President Trump vows to hit back against the EU after the bloc retaliates to US tariffs on steel and aluminium. US futures turn negative after Democrats threaten to block a Republican spending bill, raising the prospect of a government shutdown. Plus, Germany's outgoing parliament reconvenes for a special session to debate historic defence and infrastructure spending that was proposed by incoming leader Friedrich Merz.
In the meantime, a quick check on these markets. Weakness across Europe. That is what you are seeing in the futures and the currency picture. Eurostoxx 50 futures down by 0.2%. The FTSE 100 currently flat at the moment, pairing some of the losses we saw a little bit earlier. But I think weakness in the currency picture is crucial here, despite the fact that we actually had slower than expected CPI over in the States. A little bit of a ripple effect there. Euro dollar 108, cable at a 129 handle. The countdown to the opening trade starts right now.
Will you put more tariffs on the EU? Will you respond to their retaliation?
Of course I'm going to respond.
You will retaliate with more tariffs.
The problem is our country didn't respond. Look, the EU was set up in order to take advantage of the United States.
58 minutes to the European market open. A typical Thursday. We've got a potential for an escalating trade war out there between the EU and the United States, two of the great economic blocs that we have on this planet. Then we've got potentially the government shutdown in Washington. What impact could that have? Oh, yeah, and there's a massive debate about to start in the Bundestag over in Germany that could potentially change the constitution or not in Germany and allow this huge fiscal push that we are so hanging our hats on here in Europe to go through. Typical Thursday. Nothing going on out there.
Typical Thursday in March of 2025, perhaps.
Nothing to see
then,
here.
Guy. Nothing to see here. Lots on the agenda then. In terms of tariffs, we just heard it there from President Trump. His belief system about why the European Union was set up very much to take on the United States.
Yep.
That's what he said before, and he reiterates that again. Interesting to see the way that different countries have responded here to those tariffs, which so far are just on aluminium and they're on steel. The EU and Canada responding, saying this is what we'll do on this date, but we want to talk first. Some other countries actually pulling their punches and saying we're not going to respond right now because this is just a staging post in the bigger conversation around tariffs. Reciprocal tariffs, they come at the beginning of April, we know, and that's what a lot of companies and a lot of governments are really going to be focused on.
What happens next? Does this just spiral? Once you fold in the reciprocal tariffs, once you fold in the big date that is coming up, how far does this go? This is the question that markets can't answer at the moment. And it does seem as if Trump is very willing to escalate at the drop of a hat. That was the lesson that we learned from Canada when we saw that tiny little amount of electricity tariff being put on by Canada, by Ontario.
Canada throws a pebble, the United States responds with a bazooka, basically, in terms in economic terms. I think it's crucial, though, at the same time you mentioned Canada, there's a rate cut that came out in the last 24 hours as well. I think there's also a question of not just the EU policy direction and Canadian policy direction, but how does monetary policy respond when you're still kind of waiting for the reaction from the fiscal? And the answer seems to be on a dovish note.
Right, yeah, and there's a lot you just don't know about. And we've been tracking and will continue to track the responses that we're seeing from companies here in Europe as they try to navigate the haze that is the tariff agenda. Do they try and push it on customers? Do they try and push it on suppliers? Pushing it up and down the supply chain seems to be one of the strategies. Or do they just fall in line with what Trump wants and put more manufacturing facilities in the United States? Yeah,
absolutely. The inflationary concern, the inflationary ripple effect, certainly a fear. At the same time, we got weaker CPI yesterday. We're getting PPI today as well, and barreling towards a U.S. shutdown in T-minus 2 days, something that I don't think the markets were really paying attention to until literally the last 24 hours when Chuck Schumer, the majority leader of the Senate, minority leader of the Senate, basically said that he is looking to completely bulldoze the GOP plan. I think for a global audience, it's important to remember the GOP has passed it through the House. They need 60 votes in the Senate. They have 53 right now. The plan would get us to September in terms of the budget. In July, you have a budget debt ceiling. Chuck Schumer wants to extend it to April. There's a lot of push and pull here.
OK, so the House kind of pushed it through, didn't deal with the Democrats, did it on its own in terms of the Republicans, then left town.
Right.
So basically just handed it to the Senate and said, you know, here's your problem, you deal with it. The Democrats are looking at this saying, how do we contain Musk? And that appears to be the key issue here right now. And that's what Schumer's looking at, trying to figure out how he contains Musk here. What does he do with this, I think, is really interesting. the Democrats are basically proposing that they work together with the Republicans and produce something that is shorter term rather than going with this kind of super long-term plan.
Yeah.
This is their one opportunity to exert some influence over the Musk-Doge story. Do they take it? Do they have to take it?
And even the Democrats seem divided on that. Do they take on Musk? Do they try and let the Trump policies around the economy play out a little longer and see what those do and whether they force the hands of other Republicans? Reading further down our story, though, it did suggest that some sort of deal might be in the offing. So even though it is very much on the horizon, as you say, in a way it hasn't been for the last few weeks or so. But you know, 2 days is a long time in Washington.
Well, absolutely, and we wait till, of course, like that 11:59 midnight deal. I'm sure that will come through at some point. It's also important to remember because you mentioned the Doge and the Elon Musk impact. You're looking at a payrolls number in August April that's expected to show these massive layoffs that you've seen out of the federal workforce. If you have a shutdown, those numbers just get bigger.
Let's talk about another political debate that is about to start, this time in Germany. Haven't seen it for a while. What we are seeing is basically an outgoing government, an outgoing parliament being recalled today in Germany to debate this constitutional shift. Now, Friedrich Merz needs to reach across the aisle. He needs to reach across to a number of different parties in order to get this done. He doesn't necessarily have the skill set to achieve that. This is a guy that doesn't have a lot of government experience, doesn't have a lot of that kind of negotiating experience. So actually, maybe this is a more difficult debate for him to deal with than maybe we at first anticipated. Basically, you've got to get a two-third majority to get this constitutional change through. If it fails, the AfD and various other parties are likely to block it going forward, and the whole spending plan on defence and infrastructure falls apart. This is a critical moment for Germany.
Really
the key vote comes Tuesday, but it kind of starts today in the Bundestag. So
it starts today. You put this on our agenda. It starts today and it carries on until Tuesday. This vote is going to be heated, isn't it? A lot of the conversation because this is an outgoing administration being led essentially by a chancellor who isn't even chancellor yet, making such consequential decisions. Of course, trying to do it with the support of the Bundestag, but these really consequential proposals around German infrastructure spending and defence spending, almost limitless on the defence side, being pushed through by somebody who isn't even chancellor yet. So there's a lot at stake. And Rheinmetall in the mix as well. And we'll go to Ollie Crook later on for some reporting around that.
Absolutely. From a market's perspective, though, this is a done deal. We're talking about
that's
perhaps,
the problem.
that is a dislocation that may be waiting to happen, or at least a little bit of a return to reality coming next week if Friedrich Merz isn't able to pull this off.
We're going to have a big day on Tuesday. We're counting down to a number of different things. The shutdown story and also what is happening with this German debate too. Huge elements of politics inserting themselves into markets. What else is inserting itself?
Sticking with Germany, Deutsche Bank announcing its bonus pool. This is a red headline across the Bloomberg terminal. The bonus pool hitting a decade high at €2.5 billion. If you think about where rates have gone over the last half of that decade, I suppose, then banks have been doing pretty well on the back of the higher rates environment. Of course, recently we've seen rate cuts. But if you're talking about where bonuses have been in the last decade, then I suppose that fits with that narrative. But no doubt that will be a story that is well read on the Bloomberg terminal.
Bonuses are back in Europe, it seems. We'll talk about that maybe a little bit later. Let's talk about what we've got coming up on the show. Eduardo Lecubari, JP Morgan Chase, Global Head of Small and Mid-Cap Strategy, joining us. Florian El Po, Lombard Odier, Investment Managers, Head of Macro, is going to be joining us a little bit later on as well. We've got Sille Pettai, CEO of SmartCap, an Estonian firm that has launched a new fund for investing in defence and weapons technology. Basically, we've got a series of names that I am struggling to pronounce this morning, which is going to make the show very, very interesting.
I'm looking forward to you introducing them.
Honestly, this will be something that's worth definitely tuning into.
Also on the agenda, we should talk about some of the other data that is coming and going to be hitting the wire. 10 a.m. UK time, Eurozone industrial production data. And just about 2.5 hours later, the focus shifts to the U.S. U.S. PPI and jobless claims, of course. We were talking about that weaker expected number in the CPI report. Do we see it also reflected in the PPI numbers and the jobless claims today as well? Plus, the EU and South Africa summit, something that I believe Ursula von der Leyen will be attending. And, of course, speaking of summits, NATO Secretary General Mark Rutte will meet Donald Trump, I believe, in Washington, D.C. We'll see what comes out of that.
I love inflation data recently because you get to tell whichever story you want to tell, it seems, off the back of it. So the CPI data yesterday, either you said, look, the economy's fine, inflation's not this is going to be a good thing for the economy, it's not going crazy. We're not talking about stagflation, at least, but others saying, but if the economy is weak, that's what's generating the weakness that we're seeing in inflation. And some people saying, well, we haven't got inflation yet because the tariffs haven't been imposed. There's just many stories you can tell through that inflation
So we get
number.
PPI today, and in some ways PPI is going to show maybe more of the tariff story. because it's kind of
Further up the supply chain.
further down, further up, depending on your point of view. So, and also, but this number also feeds through into the Fed's inflation numbers as well, so quite maybe a little bit more consequential. But yeah, no, why is the economy slowing down? Is the consumer kind of pulling back? So we're going to have capital economics on the show very shortly. Jennifer McEwen talking about the fact that could be the case, that consumers are basically pulling in their horns and not spending as much. Is that going to start showing up in the data?
But the divergence, I think, between the CPI and PPI numbers will be interesting as well, because we've seen this in shipping rates. We've had this conversation with Maersk and with Hapag-Lloyd, where so much in anticipation of the tariffs, so many extra imports have been put up. So that's likely to show up in the PPI data that wouldn't yet be reflected in the CPI.
Right, to try and get ahead of that tariff narrative and tariff imposition. Interesting whether we see volatility around this PPI number, because the estimate on the Bloomberg terminal, the Waco screen tells me it's 0.3%. I think Bloomberg Economics, though, has a number of 0.5%. So I just mentioned to illustrate there's a range of outcomes and expectations, and that can cause some volatility.
As we've already indicated, it is a busy Thursday morning, but we're not done yet. There's plenty of other things you need to know as well this morning. The Bank of France has cut the country's 2025 growth forecast to 0.7% from 0.9%. The move means it's expecting the weakest annual expansion since the COVID pandemic. The bank sees the deterioration being caused by anticipated global trade war, the prolonged budget negotiation story in France, all of that's denting business confidence at the start of the year. Intel has named Lip-Bu Dan as the next chief executive, entrusting a former board member and semiconductor veteran with one of the toughest jobs in the chips industry. The 65-year-old Tan is tasked with reshoring as well, the fortunes of a pioneering chip maker that has become an industry laggard, struggling with market share losses and manufacturing setbacks. The incoming CEO has already signalled that he will stick with his predecessor's contentious foundry plan, even as he vows to learn from past mistakes. And a SpaceX mission to rescue 2 astronauts stuck on the International Space Station has been delayed because of an issue with ground equipment, apparently. The crew were already seated in the capsule when the launch was cancelled less than an hour before liftoff. The mission, which will allow Butch Wilmore and Sonny Williams to return home, has been rescheduled now, we think, for Friday.
They say they're coping just fine. 12 minutes past 7 here in London. Coming up with the programme, Hugo Boss shares indicated lower on Tradegate as the sales forecast, the sales guidance that we get for 2025 comes in lower than the market had been expecting. We'll check on that stock, of course, and all of the other stocks that will be on the move in today's session. Plus, Bloomberg understands the US Federal Trade Commission, the FTC, is moving ahead with an antitrust probe of Microsoft that was opened in the waning days of the Biden administration. So interesting, there's some continuity there. We'll check on that stock when US pre-market trading opens. And remember, that's 8 a.m. UK time this week and for the next 2 weeks, as we are a little closer to our American friends from a time perspective over that 3-week period. Up next, as we've been saying, we'll talk about the economy, the global economy. Jennifer McEwen will be with us, chief European economist at Capital Economics, also brings us some views on the United States as well. And if you have any questions for our guests, please get involved in these conversations. IB plus BBTV Go. That's the function to use on your Bloomberg terminal. This is Bloomberg.
42 minutes to the equity market open here in Europe. We're certainly seeing some souring sentiment in US futures overnight. The concern now is that we see a government shutdown. Chuck Schumer, over to you. Valerie Teitel, I have to say this morning, is full of beans. Let's find out what's going on.
Guy, just when we thought maybe the detox was over for the U.S. equity market, we have another risk cropping up on the horizon, that being the looming shutdown potentially in 2 days' time. The S&P futures look to erase all of yesterday's bounce. We're very happy to see that bounce. So it looks like it's going to be a race if this move holds in the futures market. Interesting to see, though, we're seeing Wall Street banks sound a bit more rosier on the outlook for the U.S. equity market. J.P. Morgan being the latest one to say that the worst may be over for the U.S. equity market, maybe calling that the bottom is in. Guy, it was very interesting to see why they're calling for the bottom to be in. It's because they're blaming the recent equity slide on hedge fund deleveraging, and we've seen that repeated in our other reporting on Bloomberg News. Millennium, Citadel suffered some very steep losses in the month of February. It's perhaps the beginning of March was all about deleveraging, all about de-risking, and J.P. Morgan sees that this might be done, and it could be risk on ahead for for the equity market. It could also be risk on if PPI does come in cool today. We have that data dropping at 12:30 UK time, an hour earlier than usual. Will the PPI data reflect the cool CPI print we got yesterday? That yesterday's print was quite cool, Guy. All four components came in weaker than expected. We're looking to see this being repeated in PPI, maybe helping the equity market out later today.
Going to look for that data a little bit later on. Told you. Valerie, thank you very much indeed. Valerie Teitel on what's happening in the markets. I tell you what, there's another shop that thinks that we could be seeing equities going higher, and that is Capital Economics. Jennifer McKeown, Chief Global Economist, joining us now. Good morning.
Morning.
You guys think the stocks go higher because we don't get a recession. How confident are you feeling about that recession bit?
Less confident than we would have been a few months ago. We've definitely had some worrying data out of the US. We're most concerned about the data relating to the consumer. We saw that fall in retail sales in January. That was largely a weather effect, we think, so hope that might rebound. But then we've got some more timely data from the Chicago Fed, the CARTS retail sales data, which are painting a pretty negative picture as well. So there's a lot resting, really, on the March 17th official retail sales data and whether we see
That's the next big print you're watching out for.
Yes, yeah, really.
In terms of how you see the consumer responding at the moment, what are you looking at? What is driving this shift? Is it just simply uncertainty? Is there an expectation that inflation goes higher? What is it that you think is unnerving the US consumer potentially?
Yeah, well, it's an interesting question because you might think that consumers would spend more in advance of tariffs, thinking prices are going to be higher tomorrow, and that's what importers are doing. They're bringing forward their imports, but consumers aren't doing that in the US. They seem to be pulling in their horns instead, raising precautionary savings. Perhaps they fear that they might lose their jobs over this. Perhaps they're concerned about a sharp rise in inflation. Certainly consumer sentiment has fallen off, and that's consistent with this softness in spending. I hope that it's temporary, that a lot of it's about uncertainty, and that once things are cleared up, hopefully deals start to be made.
That would be nice.
Then maybe the consumer, gets back on track.
I'm looking for a date in my diary that says that things are going to be cleared up.
Yes, I know.
Yes, I'm not really sure when that date is. If we can find that would be helpful, I think, for everybody. It'll be a real public service. Now, are there different groups of consumers in the US, and are they demonstrating different things? Because Guy was talking earlier this week about this news out of Delta Airlines saying there's a bit of concern around high-end. There are different trends going on there, but high-end consumers in particular. And then other reports I've seen break things down into the expectations that Republican voting Americans have versus Democrat voting Americans, and they have different expectations about where inflation goes. Are you seeing different groups of consumers behaving differently? Is that part of the consumer confusion at the moment in the States?
Yeah, well, different groups will always behave differently, and what we'd seen kind of prior to this news from Delta was that consumers at the lower end were feeling the pinch much more from higher interest rates, so loan delinquency rates were going up among those lower income ends, which is a real concern. I think really what matters most is the aggregate and what's happening to consumers on the whole, although obviously it will matter a lot for individual households.
And that's going to play into your expectations for the US economy, of course. First quarter GDP, then, you expect that to drop, but then a rebound. Is that because you think there's just a sort of period of adjustment around tariffs and around a lot of this news flow, and then we can carry on as we were?
Yeah, in part, I think there's a period of statistical adjustment. So we've seen this surge in importers trying to get ahead of the tariffs. That ordinarily you'd expect that to be reflected in a rise, either a rise in spending or a rise in inventories. And for some reason, the data aren't quite adding up at the moment. It's not that uncommon for that to be happening, for there to be timing issues around the data. So I think that statistical effect is probably a temporary one. I think also there's some weather impact, as I said, at the start of the year on spending, which again is a temporary one. So we're hoping that things get better going into Q2. We're encouraged by the labour market, which still looks pretty solid.
I'm so glad you said that, because my question is why? Especially when we're talking about so much of the immigration that has come into the United States, almost fueling, to some extent, some of the gains you've seen in the U.S. economy. Now you have this wave of federal workers being laid off, likely to be reflected in the April payrolls report, plus a crackdown on immigration. Does that tailwind completely fade?
Yeah, well, the crackdown on immigration is... we've not heard so much news on that lately, have we? But that is a concern for the tightness of the labour market rather than employment growth in itself. I think we could still get some modest gains in employment without immigration, but you'd get, real tightness, real labour shortages, which would drive up inflation.
Yeah, I wonder how that ties in with what you were mentioning earlier about the Doge-driven Fed cuts in labour force, because one of the things about that that's interesting is to what extent the private sector mops up labour that comes out of the public sector. And I mean, that's something that no doubt is going to be a theme over the months to come as we see those Doge effects take hold in the data.
Absolutely. I mean, can the private sector absorb the public sector? I mean, anecdotally, I have a friend who's a lawyer over in the States, and she said, I'm looking for a new job, I'm looking for a wage increase, but I can't do it because I'm suddenly competing with all these federal workers who've left the government. And I think my question to you here is, when you're looking for a consumer that can digest inflationary pressures coming down the pike, looking for those wage increases, how much of the labor story muddies the waters for consumer sentiment?
Yeah, well, it does seem like private sector employment is holding up pretty well. We had a 170,000 gain approximately in the non-farm payrolls data, so that is not consistent with the private sector that it is crumbling. If we look at surveys, etc., there's not a sign really of a labour market collapse. So we do think that some continued private sector employment gains can help to offset those cutbacks in the public sector.
Can I just turn our attention to Germany? There's a key vote starting in the Bundestag today that's leading up to a big vote on Tuesday about whether or not Friedrich Merz's spending plans, defence and infrastructure, are going to go through. It's kind of a make-or-break binary story because they're not going to have another shot at it if it doesn't go through. How pivotal, how binary is this for Europe that vote succeeds, doesn't succeed? If it doesn't succeed, how different will the European picture look? Equity markets are rallying. Expectations are that we're going to be seeing maybe the beginnings of a turnaround in the European economy, driven by maybe higher government spending, particularly out of Germany. How big a moment could that be for the European economy?
Yeah, I think it has been quite important. Of course, the Eurozone economy is still barely growing, so quite a lot hinges on anything that can get some growth out of Europe at the moment. We're hopeful that the proposed defence spending plans could add about 0.5 percentage points to German GDP growth in 2026. It would take a while for that spending to come through. When you're starting from a base of almost nothing, 0.5
is a big number.
Yeah, it's quite a big number. So yeah, we're really hopeful that does go through. I think even if it doesn't in this vote, then there will be scope for there to be further negotiations going forwards to try and push through some changes to the debt brake to allow this defence spending to happen.
Very quickly, should the ECB be worried about the inflationary impact of that? 20 seconds.
Not very, because the economy is so weak. I think an extra 0.5 on GDP growth isn't going to cause a major inflation concern.
Perhaps they'd welcome that instead. Jennifer McEwen, Chief Global Economist over at Capital Economics, joining us around the table on both sides of the Atlantic. We thank you so much. Coming up, we're going to stick with that conversation on Germany. German lawmakers preparing to debate, as Guy mentioned, hundreds of billions of euros in infrastructure and defense spending. We're going to continue the conversation from JP Morgan Chase, joining us to give us a small and mid-cap view. This is Bloomberg.
Welcome back to the programme. 30 minutes from the start of the European equity trading day. And compared to recent days, other days that we've known over the past couple of weeks, the moves we're expecting this morning don't look that substantial. We look as if we will be in a bit of a holding pattern at the start of the trading day. We've come off a day where we got CPI data out of the United States. We've had plenty of tariff news flow to deal with in the past 24 hours. It's calmed down a little bit. We're waiting for perhaps a flat start to trade. US futures, though, look a little bit more negative. And that is interesting because there is talk of a shutdown in the United States. And that perhaps is weighing on sentiment a little and may do more so as we get towards the US Open. In terms of the bond market story, yesterday, this time we checked on bond markets, we were seeing a slight drop in those yields. Today we see a very slight pickup in the yields, not really by very much. Waiting for news out of Germany, no doubt, about how things go in the Bundestag between now and Tuesday on these crucial votes then, Kriti.
Absolutely. Let's go there next. Germany's Bundestag, as you mentioned, convening a special session to debate plans by Chancellor and waiting Friedrich Merz to dramatically boost defense spending. It also comes as you're seeing a little bit of a ripple effect in the corporate space. Rheinmetall, for example, seeking to expand its production potentially in idle Volkswagen plans. Our very own Oliver Crook is all over the story. Joining us now from Berlin. Ollie, let's take this piece by piece. Start with the politics. What's the likelihood that this motion will pass?
It seems that the market has certainly priced that basically this is going to happen no matter what. I think there's a little bit more skepticism when you look at sort of kind of the intricacies of the politics of what's required here. We had those objections from the Greens. We've heard from them saying that basically they'd like to get an accord, and I don't think that that's going to be the biggest hurdle. But without getting into too much of the sort of details of the sort of procedures here for the German government, this still needs to go to the upper house, the Bundesrat, where you could have some actual complications in terms of the arithmetic of getting that 2/3 across to actually reform the debt brake. I think the base case still is overall that this is going to get passed, that Friedrich Merz is going to be able to get this done and get that reform to the debt brake, which could unleash up to, we don't know how much, but potentially €1 trillion worth of spending across infrastructure and defense, which obviously would have a material impact. I think that where you're going to have more difficulty going forward for this politically for Friedrich Merz is that this is a chancellor now, a chancellor in waiting that campaigned on not reforming the debt brake, and then basically within a week of being elected without forming a government, basically is using the old mandate to go against that election promise. Again, that may not sort of hurt in the immediate term, but that is certainly going to be more ammunition for the AfD in the future of this sort of political situation here in Germany.
Let's talk about how this is going to change the German economy. We are going from butter to guns. We are going from Volkswagens to tanks. Let's talk about what Rheinmetall has planned.
Yeah, so listen, we heard from the Rheinmetall CEO yesterday speaking after their earnings came out, and he basically spoke very openly and very specifically about taking over potential Volkswagen operations, right? Full plants, basically, in order to convert that from making of cars to making of tanks and basically heavy armored vehicles. There's a factory that's just outside of the Netherlands and sort of the western side of Germany that is going to go idle in a few years' time for Volkswagen. And this is something that I spoke to the Volkswagen chief financial officer about earlier this week when they had earnings out. I basically asked him, would you be willing, would you be happy if basically the defense industry were to take some capacity off of Volkswagen? Here's what he had to say.
It's really a chance for transformation. Look, we have to adapt to market realities, but we have well-skilled workers, we have factories, and there's an industry that need well-skilled workers and they need factories. So this is really a chance for our transformation.
So is that something you would welcome then?
Absolutely.
So basically, this would actually solve two problems, right? On the one hand, this is a sector, the defense sector, that needs skilled labor, that needs massive operations. And if these sort of orders keep rolling in, we should say that the Rheinmetall CEO says that basically any factory takeover is contingent on getting more and more tank orders, but basically also solves a huge problem for the auto industry where you have way too much capacity here in Europe. And this would be a way to basically very easily politically and really sort of to diminish the harm to the economy, to shift things from a declining industry, which is the auto sector, into the defense sector.
Yeah, what more visual representation of the shift in the German economy would you need than a VW factory making armoured vehicles instead? Oliver Crook, thank you very much. We'll monitor that story as it develops. Bloomberg's Oliver Crook, of course, in Berlin. Let's pick up on the defence theme and how it's going to play out for various companies around Europe. JP Morgan strategists say European defence stands to be a meaningful winner from increased government spending in the region. The team has upgraded Germany, this is at the small and mid-cap level, I should say, to overweight on a 12-month view as a result of proposed spending plans. At the same time, the team has cautioned that fiscal expansion will have a more muted impact on Europe's economy and stock market than many expect. Let's get into the details. Eduardo Lecobari joins us, Global Head of Small and Mid-Cap Strategy at JP Morgan Chase. Eduardo, nice to have you with us. So let's kind of get excited about Germany and then pour cold water on the story all at the same time, Eduardo, because you suggest that the consensus is expecting too much from this German spending push. It's not going to be as good as people think. Where does the scepticism come from?
Well, I think if you just look at, first of all, the math, it doesn't quite add up. So I think there is a very easy number to do. take the spending that has been announced, which it has to be approved and delivered, but let's assume it does. Take the spending and put it as a percentage of total revenues for all the traded companies in defense in Europe or all the traded companies in infrastructure in Europe. And what you find is that it's actually quite meaningless. But perhaps this is the beginning of a bigger thing. So what if Germany could go to 100% of debt to GDP, which means 2 times what they've announced, and every other country in Europe that is not at 100% already goes there in the same fashion? What does that mean? It only means 7% upside to infrastructure revenues in Europe and 64% upside to defense revenues. So to me, the big winner is defense. Infrastructure, pick your battles. The economy, the equity market in Europe overall, pretty insignificant.
Okay, so there is a win for the defence sector, as you point out, and so you've upgraded Germany to overweight with some of that in mind. You've added to defence stocks in Europe. How do you see that spilling out into the rest of the economy then, the defence spend? Because some of it could go to the United States, some of it doesn't have a big multiplier into the wider economy anyway, some of it will be a lot delayed. How do you think it flows through?
So that's exactly right. The multiplier isn't that big, and the weight of defense in the broader economy isn't that big. And that's exactly why all this money, which will make a real dent in defense, is not really going to matter that much on the broader economy. So if you take it country by country, the country that stands to gain the most is France. And when you do the math, it's a 7% upside to the equity market in France. That's all it is. But in defense, it's going to be big. We've highlighted a few names: MTU, Theon, Indra Systems, Kinetic, Babcock. There are things out there that still in defense, in Smith, are really cheap, and those are going to have a decade of good news.
Are we at the stage yet where we need to be factoring for small and mid caps, purchasing power, supply chains when it comes to the defense sector, or are we still in the excitement phase?
Yeah, well, it's hard to see because one of the things you touched on, Anna, is it's hard to know where the money is really going to go. I am assuming, to try and make the most bullish argument possible in Europe, that all the money spent stays in Europe, which is probably not going to be the case. Even then, you have this kind of math. I think the big winner, where the real demand is going to be, and maybe there will be some supply chain issues, and maybe there will be some, having to adjust on the cost side. But the big winner here is defense. Apart from that, is a drop in the bucket.
Well, the irony of this is that even though you are looking for this giant spend on defense and perhaps not even considering the supply chains, this is coming at the same time as we have these steel and aluminum tariffs. Anna alluded to it earlier. Exactly. That is a key raw material for this defense sector. What is the very first hurdle, the first red flag that maybe you're watching out for when it comes to the believability of this full 500 billion euros that's been promised?
Yeah. Well, I think before we even get to that, you touch on something that is, for me, crucial, which is we have a whole lot of other stuff apart from the spending plan of Germany going on. And so I think that consensus is making a very, very simple kind of analysis of GDP is investment, consumption, government spending, exports minus imports. And therefore, if I increase government spending, GDP increases. I think the mistake on that is all these other letters also matter. And you just touched on tariffs. And my question is, what are tariffs going to do to private investment? What are they going to do to consumption if they are inflationary and they deliver a higher for longer interest rate environment, for example? So I think there are a lot of moving parts here. Not everything is positive. The spending has a muted impact, but everything else is not looking great. And I think today consensus is a bit too bullish.
Let's talk a little bit about small caps and the numbers that I see on the screen in front of me. So I go to my WEI screen and I look at kind of what the S&P's done so far this year, and it's down by 5.83%. I then turn to the S&P 400 mid caps. They're down by 4.91% year to date. The S&P 600 small caps, we can talk about the Russell as well, down by 9.74%. Basically, small caps are underperforming. Yeah. Is that the right thing to do?
No. So, yes, small mid-caps are underperforming year to date in the US and in other parts of the world. I think consensus is getting this one wrong. The big talk here up until Germany is tariffs. Yep. And I think consensus thinks this is a lose-lose win. I think it's a win-win-win for Smith. Because tariffs really mean three things. They increase risk. They increase potentially interest rates, so higher for longer kind of thing. And then they should probably get you into a preference for more domestic. Well, Smith is more domestic. Smith, against what consensus thinks, doesn't hurt from higher for longer rates.
Why not? Why not?
Well, because of the math of the balance sheet, right? So we've gone through 22, 23, where interest rates were going up and small mid-caps hurt, and so that kind of is sticking in people's minds, right? Higher interest rates is bad. True. Higher for longer is not higher, is higher for longer. That's not bad for SME. Why? Because large caps have 85% of their debt in fixed. So 85% of the program they still haven't faced. But if interest rates remain high, they're going to face it every year for the next 8, which is the average maturity. As mid-caps have 40% of the debt floating. They've taken 40% of the pain already. So if we stay here for 8 years, that's bad news for 8 years for large caps, right? Mid-caps have suffered 22, 23. As long as we don't see interest rates go up more than 100 basis points from here, we're good.
And the third point? I can't remember.
Well,
the third point. There was definitely a third
domestic
point.
preference.
That was it.
The domestic preference thing is very simple, right? If you have tariffs and they worry you, the more domestic you are, the less worried you are. As mid-caps are more domestic to the tone of like 20% of revenues more domestic than large. So that helps. The part that I think, consensus is getting wrong is tariffs means risk. Risk usually gets you out of beta. Beta is SMID. That's why people are saying sell SMID. But the problem is SMID versus large has underperformed by 37% in the continent and 37% in the US in the last 3 years. The biggest ever underperformance we have seen before that is 14% in the US, 8% in the continent. We're talking 37% down.
Do you need to exclude big US tech, though, from those comparisons? Is that skewing that comparison to a meaningful degree?
Not really. So you can run the numbers in a different way. You can look at the average return, so that way you exclude the max 7, the average return of a SMID, the average return of large, and you'll find that this time you've seen the biggest underperformance ever. So my point is the pain in a SMID is already behind you. Even if this is bad for risk, it's not bad for a SMID. A SMID already took the pain.
But are you seeing a hurdle in terms of funding some of these activities? I mean, it feels like when I initially talked about purchasing power, if you look over at the States, the ones who are making the biggest example or the biggest investment, I should say, in a new burgeoning industry, we're talking about defense in Europe, but in the States, the question is AI, right? It is still the hyperscalers, still the biggest players. The small caps haven't been able to break into that because they don't have that same liquidity and the same kind of cash that they're sitting on. Does the same apply in Europe when it comes to the small caps and the mid caps, that participation in the growing industry isn't able to fully materialize because of that same lack of liquidity?
So, Kriti, I think that's a great question, and that's definitely a pushback I get, right? Like, AI is real, it requires resources. Resources are in the hands of large caps. They're going to be the ones that benefit. I really question that. A couple of ways. Number one, you could have made the same argument about e-commerce. It didn't happen that way, right? What's the key benefit of AI? That you're going to be able to do more with fewer people. So it's going to really benefit the companies that are more labor intensive. Which are those? SMID. And number two, if you really want exposure to AI, you won't get it even out of Microsoft. If you look at consensus estimates of earnings growth for that company, 15% next year. Because it's a big business already and AI is going to be a part of it. Yeah. You want exposure, you want a pure play, you want an IPO. 99% of all IPOs are SMID caps. So I think, like it happened in e-commerce, AI is actually going to benefit SMID more than large.
OK, that ties in really nicely, actually, Eduardo, as we finish the conversation with what we heard from Sage Group yesterday, also servicing the small and mid-cap sector, talking about how that AI pickup from that sector is going to be in the next 12 to 18 months. So that, to your point, is an interesting one to watch.
Applications. Yeah. The big stuff's priced in, and it's hard to get the read-through from some of the big-cap stocks. But with applications, you can start to see the effect. But that's what the market's been waiting for, which is basically the idea that
when it gets real,
that it starts to get real.
Yeah. But Sage really throwing cold water on the idea as well that AI equals a diminishment of labor, and he said that's not the replacement factor
that
everyone's worried about.
Pickup.
Yeah. Exactly. Lots to digest, lots of different factors. Eduardo I'm going to say this right, Lekubari, I'm sorry, Global Head of Small and Mid-Cap Strategy at JP Morgan Chase, joining us around the table to walk us through really the two main themes that we are seeing this morning. Coming up, we're going to bring you the stocks to watch ahead of the opening trade, including Hugo Boss, as the German fashion brand's sales forecast misses estimates. More on that conversation next. This is Bloomberg.
Welcome back to the programme. This is the opening trade, 7:48 here in London. So 12 minutes until we get this kind of start for European equity markets. The futures picture looks negative, but not by much, down 1/10 or 2% on major markets, maybe a little bit more than that over in Germany. In fact, waiting for lots of politics to play out in Germany over the next few days. We're also waiting for politics to resolve itself, perhaps, away from the prospect of a shutdown in the United States. That seems to be weighing on US futures right now. Our Markets Live executive editor Mark Cudmore joins us on set in London. Mark, good morning to you. So let's start with sentiment in markets and the price action, because we look at a futures picture for Europe, looks kind of flat to negative. US futures down quite a bit, 0.6% lower on E-minis. Doesn't seem as if we found, well, JP Morgan's talking about the floor being in for US stocks. Doesn't seem as if we found it just yet.
No, it's really notable how poor the price action is across all assets. We've seen some quite incredible moves in the last couple of weeks, not just on the US stock side, but what we've also seen on the yield side, what we've seen on the currency side, what we've seen, we're not seeing that pullback, for example, in euro dollar, even the short term. So really the price action right now is that, yes, these moves have gone a long way very quickly, but there's no kind of real relief bounce, which means I don't know whether we've had that complete capitulation yet. It doesn't feel like a market that feels fresh enough to buy the dip. So I am worried by people who think we've already seen the worst of the correction so far. To me, it seems like even in the short term, as in even in the next week or two, we're probably going to have some more negativity. And that's why I think people are ascribing some of that negativity to the government shutdown, even though I don't think that's really that big a story. I think that's like a narrative to fit the price action. I think retail sales on Monday is important. I think we've got the Fed coming up. So I think there's a number of catalysts that might get us one more washout, it seems, before we can get a bit more of a dip buying.
You had your macro dinner last night.
Yeah.
Consensus? No consensus.
No consensus.
So what does that tell us about where we are in this market? There seems to be a hot debate about everything at the moment. Do we need to see one kind of area of resolution before we can start to see the bounce that maybe you're talking about coming later down the road? At some point, the stars are all going to align. I'm just kind of... Is there a sense of where they start to align first?
No, I think not, because I think the problem is so many of these issues are not going to be quickly resolved. So obviously, Europe's quite a big story, for example, but does Europe have the fiscal room to really kind of follow through, and when do we see the impact? Some people who believe that the story is more important than when we see the fundamentals. I'm in that camp. I think the paradigm shift has happened for Europe, but there's certainly debate there. Other people still debating about, how impactful tariffs will actually be, and whether, a few months from now, whether the average effective rate of tariffs in the US will actually be significantly higher. Then other people there's a massive divide of how much the Fed responds to some of the slowdown we're seeing. So I think none of these issues are going to be quickly resolved. I mean, the Fed will probably be the first one we get a bit of a signal on, but I don't think that's enough. And then there's the real debate about how much is the economy actually slowing, and then probably maybe the most important for that, whether we get a US economic recession, is how much fiscal retrenchment are we actually going to get? There's a lot of people who are pretty cynical that there'll really be much cutting back. Some people even think there'll eventually be fiscal expansion this year, which means you're never going to get a technical recession. So it's very much debate out there still.
So what's the hedge with all of that? Are people just storing cartons of eggs in their basements, or are they doing Bitcoin? Eggs are the inflation hedge, aren't they?
It's interesting you say. I mean, it's certainly there's still a very strong passion for gold, which we know has performed so well recently. People are talking about what the other havens are out there. What I found was interesting is that that there was no consensus. Like normally I come away from these things and you're like, oh, most of the room was very much one way or the other, and certainly on every issue there might have been a slight majority, but people had high conviction just in opposite directions. It wasn't like, oh no. It was like, no, I strongly believe this. No, I strongly believe the exact opposite. So I think it's still a really vibrant trading market. There's still a lot of opportunities out there. I'm in the camp that we are seeing a paradigm shift in Europe, and therefore bigger retrenchment in other assets.
So no eggs for Mark is what I got out of that.
Not a gold, maybe.
I don't like sardines, I'm sorry.
I think you're in the consensus there, Mark. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is a function on your terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So there's a group of investors looking to potentially buy the German-listed company Gerresheimer. Now, this is an interesting firm because they make the syringes that are used by Novo Nordisk and other weight loss companies for their drugs, including Wegovy, Novo's big one. So therefore, seeing some interest in this firm. We saw the gain in those stocks given the tie to that sector, and a lot of positivity on this stock. 18 buys, not a single sell rating, though we have seen a couple of other reports over the past few months around investor interest, so potentially a little bit of that priced in at the moment. Then we're going to look at Hugo Boss, now looking pretty weak once again on some of their numbers. We are seeing some weakening of their sales once again. However, this is one of the worst performing luxury stocks in Europe over the past year. So again, the negativity potentially already factored into the share price. We're down around a third on the Hugo Boss stock over the past year. We'll see whether this is enough to kind of relieve the stock. I did see some mixed calls out of the market makers this morning. Then over in insurance, a couple of big names. We've got Generali and Hannover Re, both of them increasing their dividends amid a strong insurance market. Generali has been the outperformer of the two, given they recently had that big investment from UniCredit, so that really lifted the stock there. So keep an eye on those two. Finally, on the ratings, Jefferies is initiating on all of the defence stocks today. Rheinmetall by Hensoldt is underperformed, but the one I like for me, Schneider Electric, double upgraded from sell to buy at Goldman Sachs. Expect that one to be higher in Paris this morning.
Joe, thank you. From our equities team, of course, Joe Easton. Also keeping an eye on Deliveroo. We got numbers there that seem to miss estimates, so that one could be one that's a little bit lower at the open. But it's not a day for a huge amount of individual stock moves. A sense of waiting for the next bit of news flow, I suppose.
And there's plenty of kind of options you can look at in terms of where that news flow could come from. We'll see what the tone is like in the Bundestag a little bit later on. We'll see developments potentially in Washington on the government shutdown. We've got PPI data coming a little bit later on. Cheltenham's on as well. A lot of focus on what is happening with the horse racing. It's Ryanair Day at Cheltenham, basically.
Nasdaq futures down 1% now, Kriti.
Yeah, absolutely. And we're going to see how much that changes at not only the opening trade in Europe, but of course the pre-market trade in the States as well. That next, this is Bloomberg.
Thursday morning, so let's have a little history lesson and talk about yesterday, distant memory. What we saw yesterday was an effect of the CPI number, which came through a little bit better than some people had anticipated. We didn't see a push higher. We actually saw maybe a little bit of underperformance coming through there. Didn't seem to spook the market, though. There could have been a concern maybe this is because of an economic slowdown. That didn't seem to happen. Anyway, the net of all of this is that US stocks rally. Europe captures a little bit. Europe actually goes out kind of where the US closed as well. So there's no real steer coming out of today out of yesterday and today, Kriti. But there's lots of news overnight that mean that US futures are quite negative right now. That is feeding through into Europe.
It absolutely is, and you can already see it because we are, I think, to your point, expecting that bounce back. There's no evidence of that in the futures picture. That could change, however, in 2 minutes' time, Anna. Eurostoxx 50 futures down about 0.4%. The FTSE 100 less volatile than its counterparts in Europe. But again, as Guy said, the real story is in Nasdaq 100 futures down a whopping 1% now. We'll see how that changes in the next few seconds.
Yes, absolutely. We will focus on a few individual names here in Europe as well that could be on the move. Let's start with one stock that Joe Easton put on our radar, which is Gerresheimer. This is a German-based packaging manufacturer. It supplies the drug sector, the cosmetics sector. Crucially, it supplies Novo Nordisk and others in that space around obesity. Private equity said to be interested here. There are talks happening between this business and PE, a potential deal there. Hugo Boss in focus as well. Guidance seemed to miss expectations here for this sort of luxury end or high-end consumer-facing business. They're citing macro factors. They're also citing the geopolitical volatility that we seem to talk about on a day-to-day basis. And Deliveroo in focus. Weak guidance also an issue for that one, Guy.
Here we go. 10 seconds until the European Open, which is going to be influenced by the US Open, I suspect. Futures are quite negative in the States. How does that feed through into Europe this morning? Let me show you time for the opening trade. These are the first numbers. Let's take a look at them, give you an idea of what is going on. A negative print out of the gate for the FTSE 100. You could expect this to be replicated elsewhere across the continent this morning. The US futures picture is being influenced by a bunch of factors, one of which, of course, is what is happening in Washington and the government shutdown. Stock 600 actually comes through flat. There's a little bit of green on the screen. We'll see how long that lasts. The expectation is for a, let's call it, circa 0.5% down move, maybe across Europe this morning. Does it turn out to be as negative as that? Well, the CAC's certainly not moving in that direction. We're down by 0.1%. The IBEX, though, may be more consistent with that narrative, down by 0.5% at the moment. But we're trying to think about how the US Open is going to influence Europe. There wasn't much steer out of yesterday into Europe this morning, so we're kind of looking ahead a little bit to what could come later in the session Thursday for the US, Kriti.
Absolutely. When I'm looking at these markets and what's driving it, it's a tale of two tech stories. And I think this one's interesting here because when you look at the downside, of course, tech is weighing the market down. We're seeing that in the NASDAQ futures as well that continue to drop. So names like ASML, SAP, even ASM in the chip-making space, all pulling this market down. But you have a couple of standout outperformers as well, along with the defense trade that's showing up as the outperformance, the likes of Schneider Electric. So to me, it feels like this market is quite divided on what's moving. But net-net, you are seeing underperformance across Europe. Anna, telecom and healthcare having a good day, but perhaps because those were the underperformers in yesterday's session.
Yeah, absolutely. Retail was a big underperformer in yesterday's session as well. We were really focused on the consumer-facing things, weren't we? Healthcare is doing well. I wonder if there's a bit of that M&A in there, even though we don't have an opening price on Gerresheimer, and it's not the biggest business, but there is some private equity interest there. And that's interesting. So that's, you know, a defensive sector, isn't it? And it's at the top of the gaining list today.
The breadth is really horrible, though. So you've got 137 stocks up at the moment in the stock 600. You've got 432 stocks that are lower this morning. So if you take a look below the surface and take a look at the breadth, that's pretty poor right now. You've got 30 unchanged. We'll see which way they come through. There could be some critical stocks in there. At the moment, in terms of the points, it's Volvo, ASML, NatWest, LVMH, BBVA. So there's a real mix of stocks moving on the downside, which tells you about that, speaks to that breadth story, that a lot of things are lower.
And I wonder if autos is the weakest performing sector, and I wonder if that has to do with the threat of another round of tariffs coming from the White House. So, no, it's not news that President Trump is wanting to impose tariffs, but the fact that he said, yes, we'll go again. We did ours. Europe's doing theirs. We're going to take them on again on tariffs, so that perhaps adds up to a little bit of a leg down for autos.
The defence stock's doing the heavy lifting.
Yeah.
So, yeah, Nova's up, Schneider's up a little bit, but then you get into, there's some banks up as well, but Rheinmetall, Safran, Airbus, Rolls-Royce, BAE Systems, Leonardo, these are the stocks that are doing a lot of the heavy lifting on the upside. Feels like a defence story that's lifting Europe. Everything else certainly doesn't paint such a positive picture at the moment.
Absolutely. It's interesting, though, that the auto sector, including all the early indications of Volkswagen shares, aren't actually moving to the upside because we did have the story of this kind of reshuffling of capacity when it comes to the auto sector to the defense sector. I don't know how you trade that in this market, but of course, as we are really kind of looking through all of these various drivers of the market, we are still awaiting the DAX, which I should mention has not opened yet, but we are seeing some of the initial movers in the stock 600. So when we do get, and the DAX has just opened, as I'm speaking, down about 0.4%. But again, not that massive pull down that perhaps we were expecting. Let's bring in a true expert here. Florian Ielpo, head of macro at Lombard Odier Investment Managers, joins us around the table. Pleasure to have you on the program. Thank you for joining us. We are waiting for what that buy the dip signal is. What is it, in your view?
First of all, thanks for having me. What's odd with the current market move that we haven't seen this layer of liquidation that usually ends the kind of trend in which we've entered over the past, 2 weeks now. What we would need for that is, either a definitive macro bad news. Maybe we'll have a bit of that with the PPI today, but it's very unlikely. The retail sales in the US would be probably the occasion to see like a slowdown in the US really materializing. But so far it's purely speculation. So far it's purely sentiment. At the moment, the way we see the situation is rotation, not recession. And it's a very important thing when you see this open this morning to remember that something's up there, the triple layer, the rotation that's currently happening. And one of that layer is out of the US towards Europe. Now, Europe this morning is getting a little bit shaken because Europe hasn't faced so far trade tariffs for good. We haven't had this genuine exchange that Canada and Mexico have had with the US so far.
You talked a little bit about the rotation. JP Morgan is making the call that the bottom is in simply because a lot of this deleveraging has already taken place. Are you seeing evidence of that?
I think there is a lot of speculation around hedge fund selling their position, triggering that movement. I doubt that this is what's happening. What happens with hedge funds, like their short position getting covered, is usually a market move and not their longs. Now, if you've been looking at the AAII survey, which I tend to see as a retail investment survey, you've seen a sharp decline basically in February. So I suspect also that retail money has been exiting the big names driving the NASDAQ, and that is creating some kind of contagion feeling that we can see this morning. You see, retail money is difficult to measure, but you can suspect that it's been playing its own role recently.
But you're not seeing this kind of liquidation story that you would need to see for a bottom to be in?
Yeah, we're just out of our investment committee, so it's quite nice to be with you this morning. We have diverging views, of course, but most of our PMs are saying we're calling for resilient portfolios. We're calling for cautiousness, not defensiveness, because we haven't seen that last leg of a natural, highly valued liquidation market. And we need to see that to be...
How ugly could that be?
With a recession, without a recession.
Okay, with a recession, how ugly could it be?
With a recession, you could see Ps in the US go back to the range of 16.
Wow.
So that would be large. It's 4.4K, something like that on the S&P. That would be a very big call. It's not our call at the moment because, again, we're not seeing this recession happening in the US. What we're seeing is a slowdown in the US, but the rest of the economy is doing quite nice. Europe is recovering, China is recovering, and all of that is creating some kind of a rest of the world put. We don't have a Fed put, probably because of tariffs. We don't have a Trump put because he cares about rates more than equities. All we've left with is basically this rest of the world put. But it's happening. The recovery is there, and the difference in terms of fiscal spending in China and Europe is massively different from the US.
Yes. So you mentioned in your notes, and I think it's just we're starting to get to that point in the conversation where this is US exceptionalism, but by a very different definition. A different version of US exceptionalism, a less positive version of US exceptionalism. And you talk about that because of the way that the US economy you think is slowing, how it's fiscally consolidating, the Fed's in a different place, and there's a lot of rotation happening within the United States. But how far through that story are we already? Or does it have a long way to go? Is that going to be the story of 2025?
That's pretty much the story of the year. The story of the year is what Scott Bessent mentioned. The US have created a dependency of public spending, and he wants to get rid of that. That's Doge. It's a very stringent impact on the US economy. It's called active fiscal consolidation. And usually it's a call for going away from risky assets in the zone where that fiscal consolidation is happening. So what we're progressively discovering is that this can happen in the US. Now, the good thing since the beginning of the year is that it's a unique story in the US. Europe is willing to spend more. China is clearly willing to spend more as well to stimulate consumption. All of that is creating an environment that makes it possible for investors to go away from US assets towards European and Chinese assets.
Sticking with the US for just a moment, do you see the argument coming out of the White House? Do you buy into it, the sort of economics of it, that there might be short-term volatility, don't worry about the ups and downs in markets. This is about long-term reinventing the US economy, about reshoring manufacturing back to the United States. Is that something that can play well for the US economy?
I'm going to quote one of our PMs, Dhiraj Bajaj, CIO of Asia. He says he's been observing China for a very long time. What's happening in the US has a lot to do with what was happening in China, meaning a transition from one type of an economy to another. And this transition period can be costly. So we come from this big tech ETF, which is the US at the moment, and he wants to recreate an industrial United States. And that will take time, and that comes with costs.
Costs, but benefits too, or just costs?
And benefits. What's the big difference also with China, when China did the transition from export to consumption, is that China is a closed economic space, which is not the case of the US. So as we will see better prospects in the US, outside money could be flowing back into the US economy for equity reasons, basically, which would protect potentially US equities, I'm sorry.
We've been talking about Germany this morning a lot. There's a big debate starting today in the Bundestag. Friedrich Merz is calling back the old parliament. He's trying to push through his big new spending plans before the new parliament takes over. Big vote coming up on Tuesday. Europe is outperforming at the moment. If Merz's plans go through, does that outperformance continue? Does it get put on steroids? Does it go even faster? If it doesn't go through, does that outperformance go into reverse?
We doubt that. We had a conversation like a month and a half ago, something like that. Our nowcasting indicators are very clear on Europe, are very clear on China. The macroeconomic landscape is improving. It has nothing to do with the economy, the political decisions that are currently getting decided. because basically it's not yet in the economy. So at the moment, we have a majority of economic data in Europe, which is improving, and it's a very important message to listen. Now, if you get another catalyst and with this kind of political decision, then it's all even better, and that would add to this European momentum, probably that Europe will be at least the trade of Q1, Q2 this year.
Florian Leopold, nice to see you. Thanks for stopping by to see us, Head of Macro at Lombard Odier Investment Managers. Thank you very much indeed. Call 6 looks like this morning. In Europe, you are seeing a bid certainly into the defence stocks. Trucks are on offer. LVMH Ferrari rolling over. ASML seeing some weakness. Everything else is kind of a little meh, except for the pharma space, which is having a very good day alongside the defence space. Trucks is an interesting area this morning as well. What's going on in the States with the EPA? Maybe having a ripple effect back here in Europe this morning. Joe's got all the details of the other stocks we need to be focusing on. What's going on?
So we have got some big moves in those truck stocks, Guy. As you mentioned, we're seeing Volvo, Traton hit at the open of trading. Really unexpected. Thankfully, a trader in my IB sent me a couple of links, and there does seem to be news, as Guy mentioned, around the US potentially rolling back some regulations around environmental restrictions, and that was actually seen as supportive for pricing in the truck space, according to some analysts this morning. So we are seeing that as a bit of a shock move and a decent move lower in Daimler Truck there. Volvo as well hit off that news, but a big drop. Daimler potentially going into a trading halt as well. Worth keeping an eye on that one, and keep an eye on the story on the terminal. That'll be out very shortly. Then, in terms of the retailers, we're over in Poland, one of the biggest retailers in Eastern Europe, Allegro, reporting some sales, and that was the best performing stock on the SXXP at the open of trading, and it is gaining on better than expected sales for the grocer, so a bit of a boost for that one. We're up 6% at the moment, as I say, and also doing a bit of a buyback as well for them. Then a stock not doing so well was K&S. Now this is over in German chemicals. Of course, the German sector had a bit of a boost recently, given all the spending, the government fiscal spending, but K&S reporting weakness once again. So agricultural chemicals is the main exposure there, and looking soft on the margins and outlook for that company. Then analysts are frantically trying to upgrade their price targets on Rheinmetall. They're all trying to outdo each other this morning. I've seen UBS went to 1,600. I think a couple of minutes later there was another one coming through. So Rheinmetall, once again, we're at 1,300 for that stock now. Earnings yesterday looked very strong, of course. And then we also had the Jefferies initiations coming through as well. We've got SSAB on the screen there, potentially a little bit of exposure in that space as well. Then in terms of the analyst rating changes, the one that really stood out was Schneider Electric. That was up around 2% at the open of trading, but coming back down a little bit. Goldman says that the sell-off tied to the data centre worries is overdone. They think the bear case scenario is fully priced in for the electrification stocks, and therefore they go to buy from sell. A double upgrade. We love a double upgrade, and that one is up 0.4% in Paris this morning.
Joe Easton from our equities team, we thank you so much walking us through some of those early movers in the European session. We certainly appreciate it. At the same time as the European markets open, of course, the U.S. pre-market has opened as well. Let's get a quick check on some of the stocks that are moving in that space. A lot of that concentrated in the tech space. Now, Intel is going to be a key one. Shares higher by, get this, a whopping 9%. They were up 8% yesterday. So this is a really big deal. They're talking about a new change of guard when it comes to the CEO over at Intel. Pat Gelsinger no longer going to be leading that charge, trading at about $22 a share. NVIDIA and Microsoft, though, taking a little bit of a beating. Adobe remains unchanged. Remember, we are only 15 minutes away into that U.S. pre-market, so we'll see if that crosses given the earnings story from last night. But tech broadly down. Intel, Anna, kind of fighting the charge.
Yeah, absolutely. Big moves then anticipated in Intel. Coming up, we will stick with that tech theme, in fact, and discuss whether the Nasdaq is in oversold territory. We'll have charts for you. That's next. This is Bloomberg. Welcome back. It is 8:17 here in London, and this is the picture on European equity markets. A little bit more selling, perhaps, than we were anticipating, at least if we were looking at futures. Certainly in Germany, we're down by 0.9%. The CAC 40 down 0.7%. Overall, though, Europe down just 0.3%. US futures are negative. A big tech theme running through the day ahead, it would seem. Nasdaq futures down by just over 1%. Is that to do with shutdown fears, really, in the United States? Is it other things on the agenda? Let's get to Kriti, find out what has caught her eye from a tech perspective.
Well, Anna, absolutely. I mean, that's where we're seeing most of the pain and the concentration in some of the selling. Now, some of this has to do simply the fact that tech makes up a good chunk of the S&P 500, certainly makes up a good chunk of the Nasdaq 100 as well. But this is where the momentum trades really come in handy, to the point that if you're looking for a place to find, to spot, to say this is the point to buy the dip, technicals may actually come in handy. I'm going to take you on a walk through history, if I can, to show you how true that is. Because right now, the NASDAQ 100, that is really holding a lot of those mega cap names, is hitting a key point. It is in oversold territory when it comes to that relative strength index. And that's what these red dots at the bottom panel really indicate. Every time, going to the back 2 years, that we've seen it hit the spot, it has spurred a sense of buying into the index. And you can see it earlier in 2024, of course, the sell-off driven by the European kind of debt surge and spread surge that reflected into the States. You saw it really, a lot of it, specifically in 2022, when we know that entire year was a negative year for American equities and global equities, I should say. But it has consistently pointed, and you can see on that top panel, as a place where the market has rebounded, even just temporarily. Is this time different? That's going to be the key question, especially as we get a slew of earnings that suggest that maybe some of the kind of estimates aren't actually up to par when it comes to the AI investment, the monetization, and the return on equity. That kind of exceptionalism, not just in American stocks, but in tech, Guy, can it last?
Absolutely. So there's a whole range of macro factors that we're focusing on, trying to understand what implications they all have for where the Nasdaq and ultimately the S&P trade. Single stock stories, though, there are plenty of those as well, and one stands out this morning, and that is what is happening with Intel. Its stock is up 8.5% pre-market. It's off its earlier highs, but we're already seeing a significant bounce. The analyst community sounds reasonably positive as well in terms of what is expecting from this new CEO. Lip Bhutan is the next chief executive. He's entrusted, basically, with turning this company around, a continuation of a process that has been very, very slow. He's a semiconductor veteran, but he has got now one of the toughest jobs in the chips industry. Let's talk about the big picture. Let's talk about what's happening with AI. Let's talk about what is happening with Intel more specifically, because Mandeep Singh is in Europe, global tech analyst at Bloomberg Intelligence. Great to see you. Haven't seen you for ages. Fantastic to see you here in London. So much going on. I barely know where to begin. Let's start, though, with Intel. How big a job does this new CEO have? How tough a task is there going to be ahead? He's talking already about sticking with the foundry plan. Presumably everything must be on the table, though, at this stage.
There is, and look, I mean, a guy like Pat Gelsinger, who had all the credentials, couldn't turn it around, so clearly this is tough. But I would say, you know, the fact that he's leaning towards keeping the foundry business, it was in the news that he doesn't plan to divest anything as of now. The easy, low-hanging fruit is a cost structure, because when you compare Intel to NVIDIA, AMD, Broadcom, they have 3 times more employees.
Wow.
3x. The employees of all the 3 comps that I suggested. And their revenue is almost close to, like NVIDIA, we know, is a $200 billion run rate company at the end of this year.
It's just cut. That's the job.
I think the cost-cutting could be huge. At the same time, this administration, the U.S. administration, is really keen to bring, you know, manufacturing back and reshore some of the chip production. I mean, CHIPS Act was there during Biden administration as well, but I think there's more emphasis in terms of reshoring with this administration. And if NVIDIA and Broadcom start using Intel fabs, that could be a positive. It may not be for the leading node chips, but some form of external third parties using Intel fabs could be a near-term positive.
So good morning to you, why do other analysts then put so much emphasis on the decision to keep being in the foundries business, and maybe they should think about not being in the foundries business? Why is that such a focus for some analysts?
Because the margins are terrible for foundry business. When you compare that to the core chip business that Intel has on the CPU side, I mean, foundry margins are negative gross margin. But Intel needs its own foundry. I mean, how are they going to make their CPUs? So it's on Intel fabs, and if they sell it, then it's going to be a cost for them. So clearly, I think the cost structure, the bloated cost structure, is the one that I feel he should fix first. And he's got software roots coming from Cadence. So clearly, there is that software angle where things can be pushed as well. But it's a hard job. I mean, we've seen that with Pat Gelsinger. So.
Well, Pat Gelsinger took quite a bit of advantage to those Biden chip grants, right? I mean, Intel was one of the major beneficiaries in terms of that U.S. manufacturing story. You haven't seen that in some of the other chip makers to the same extent. Does a Trump administration, do the geopolitics challenge or help that?
I mean, right now, I feel Trump's administration mandate is whatever we can bring back to America, let's do that. So if things are being made outside America when it comes to some of the chips, can we bring them onshore? And who are the options when it comes to, chip manufacturing in the U.S.? It's either global foundries or Intel. And I think Intel clearly has more, I would say, fabs in terms of CPU side. So they have more leading node capacity than a global foundries does.
If he fails, is Intel done? Is Intel broken up? Does Intel cease to exist? Is it as big as that in terms of what we're talking about here?
I would rule that possibility out. I mean, look, there are certain acquisitions that Intel did back in 2014 to 2017 timeframe that you could argue don't really tie with the core business, even if you would decide to keep foundry. So divestiture is on the table, and that's why I said the cost structure should be paramount here.
Let me go to another story that caught our eye this morning, and this is around Microsoft. And the reason for this is the politics, a continuation of the politics. So Trump's FTC is continuing some work that we saw started by Biden's FTC, and this is all around whether Microsoft is reducing the level of competition around the AI market. How does this play out, do we think?
I mean, look, the closest connection I can make is OpenAI, Microsoft, and we all know Musk doesn't like OpenAI. He actually put in a bid to acquire OpenAI. So the fact that Microsoft and OpenAI really partnered at a very early stage, and they have a 49% stake in the company. You could argue, is it stifling the competition in the AI market? What did it do to Microsoft's own investments in building their own large language model? And I do see that Musk angle because of how prominent he is in Washington, D.C.
Is there a liquidity story that works well for tech companies broadly right now? I mean, they're sitting on so much cash. The hyperscalers are investing it all in AI. Does that all come to a close if we hit a recession or tariffs or geopolitics? Does some of that cash crunch show up in some of these big tech names?
I mean, the good thing about all these hyperscalers is they generate a ton of cash. Even if we hit a recession, I mean, they can sponsor their CapEx, with their own operating free cash flow. And look, are they going to pare back in terms of the CapEx investments? Most likely, we are hitting that wall when it comes to training. But this AI wave has a very long tail when it comes to investments.
Just finally, very quickly, we got very excited about DeepSeek in China. Manus is the news story that we're talking about. Are we talking about enough? How big could it be?
I mean, AI agents is the new game, and every enterprise is looking to deploy AI agents. Manus is a manifestation of, LLM being deployed as an agent, and we are going to see more of that everywhere.
All right. Mandeep Singh, global tech analyst for Bloomberg Intelligence, joining us here in London on a day where, of course, we're already seeing some of the pre-market moves in the tech space, already concentrated in some of the heavyweights. Intel bucking the trend, though, and that, of course, is a positive. We'll see how long that continues. Coming up, we're going to talk about one of our other major themes this morning, and, of course, in the last couple of months, financing Europe's rearmament. We're going to speak to the CEO of SmartCap, an Estonian investment firm that's launched a new fund for investing in defense and weapons technology. More on that next. This is Bloomberg. Welcome back to the opening trade. We're 30 minutes into today's session, seeing a little bit of negativity on the screen, but perhaps pairing the earlier losses. Stock 600 basically flat at the moment. But if you're looking for underperformance, look no further than the German index. The DAX is down about 0.5%. The CAC down about 0.3% as well. But the FTSE 100 marginally in positive territory. We're only 30 minutes into session, Anna. Perhaps a little bit of a rotation from what we saw.
Right, yeah. And E-minis and NASDAQ futures still down, off earlier lows, but still substantially down on NASDAQ futures. We'll keep an eye on the tech sector as we get closer to US trading. Let's turn our attention to defence matters. European governments are planning to throw hundreds of billions of dollars at expanding and modernising their militaries after President Trump called into question decades of US support for, and security in the region. Joining us now is Sille Pettai, CEO of SmartCap, which invests in venture capital funds and startups in green tech and defence within Estonia and across NATO member states. It is Estonia's state-owned venture capital fund manager. Sille, very nice to have you with us. Thank you so much for being with us here on the opening trade. So I think your fund has only recently come together, so a little too early to talk about what you're exactly investing in. But tell us what it is you're looking for. What are the things that you really want to see in the funds or the startups that you back?
Good morning, everyone, and I'm so happy to join you from Tallinn. Yes. The defense fund that we launched quite recently is all about strengthening Estonian defense industry. So what we can do, we can invest in a wide variety of companies from Estonia, but also from other NATO allies. But we need to understand what they bring on the table, how are they going to contribute to developing and strengthening Estonian defense industry. We can do deals from very early stage, from seed stage, all the way up to growth equity. So we have quite a lot of flexibility to provide equity financing to companies who are willing to play a role in Estonian defense industry.
Yeah. Sille, can I ask you about the time horizons here? I understand that you take a slightly medium-term or longer-term approach, investing for maybe decades to come, or at least with a view to the next decade. But Europe needs money spent on defence in the very short term, here and now. Is there a sense that money is diverted from funds like yours to more immediate defence needs?
Currently, no, but we need to understand what the market is. You described the increasing defense spending in Europe. It is true. 800 billion euros being channeled to European defense industry, and it is emerging, it is growing. But let's take a look. You talk a lot about the stock markets and the sentiment. For example, Warsaw Stock Exchange, which is a proxy market basically to Ukraine, it is performing historically at the best levels. The same for Ukrainian stocks on Warsaw Stock Exchange. The defense stocks in Europe are up more than 50%. So that's pretty much the sentiment and the increase in prices that we see in February. And is reflecting the geopolitical sentiment. So for us as defense investors and seeing an urgent need to increase the funding for defense companies, it is clearly a choice whether we sit in cash or pay to play.
OK. Let's talk about potential areas of investment, clearly within the defence space. The Baltics, Estonia, have very strong tech sector that has emerged over the last few years. How much of what is being done there is transferable into defence skills? What is the crossover between the two? How does the Venn diagram overlap between the tech sector and the defence sector?
Maybe I'd zoom into Estonia, which is very tech-savvy country. We have extremely successful technology companies, technology sector and ecosystem, #1 in terms of unicorn companies per capita in Europe. So we have a lot to build on, and we understand where our strengths are in tech sector. So that's what we need to do, because we have no legacy industry in defense in Estonia. We need to turn this into opportunity, and again use what we have in technology sector, and that's what we also see if you look at the companies in our pipeline and that we are screening through. There are around 300 companies on our radar, around 100 of them from Estonia, and dominating technologies that we see. Roughly 20% are unmanned vehicles, roughly 20% cybersecurity and software, and the third one will be any kind of situational awareness technologies and solutions, or enabling technologies like sensors. Yep. So these are closely related to the talent pool.
Yeah. Is it easier to scale those areas? Cyber, drones, is it easier to scale up quicker in this space than maybe it is in heavy armour, tanks, those kinds of areas that the prime manufacturers like Rheinmetall are into? Is this an area that can accelerate from a standing start at a much quicker pace?
Definitely, especially when we see more innovative and advanced manufacturing technologies being brought on the market. But when we look at the newcomers and new defense technologies, what they have a very small and lean product portfolios. What they can do with very advanced manufacturing solutions, they can bring down the manufacturing time and they can bring down the cost, but also increase speed. So there is definitely an advantage or edge. And when we talk about primes, they're busy producing and delivering orders. For example, for most of the primes, their backlog is around 3 years. Let's take Rheinmetall and their numbers for 2024. The revenue was around 10 billion, backlog 55, which translates to 5 years of backlog if we assume the same sort of capacity.
Sille, it's Kriti in London. Walk us through kind of the scale question here. I mean, we're talking about private financing in the defense sector, any sector in Europe. One of the big things this part of the world has struggled with is really scaling up with some of the bigger players coming out of the United States or arguably China as well. Is scale or the size of investment a barrier of entry?
It's becoming less and less of a barrier. And we need to make a difference here, whether this is emerging tech company, defense tech company, or more established with revenues. Because not just equity financing, but bank financing, traditional loans. They look for bankable companies with solid revenues and estimates. And that's what the emerging technology companies simply don't have. So they have, the access to bank financing is basically non-existent, but you need to blend it. But what I see that the emerging tech companies are doing really well. They're blending their financing well with grants and non-dilutive financing.
So let's continue on the topic of that barriers of entry. You just made a key point there of what that partnership with traditional financing and banking actually looks like. The EU has a lot of red tape around what collateral for some of these defense deals look like, specifically around traditional banking. Does that limit perhaps the kind of traditional financing that can be partnered with when it comes to the private markets?
Maybe not the regulative or restriction and limitation side, not anymore, not in this region. We have close ties with local banks. That is not the question or number one issue. It's more whether the companies are bankable. Are they able to access bank financing because of their financials? What is the ownership structure? What are the revenues? How diversified is their customer base? And then we get to the procurement issues and very limited number of end users.
We look forward to seeing how this all unfolds as, of course, the story continues to unfold. Sille, Pettai, CEO of SmartCap, we thank you so much for joining the program this morning. And sticking with that defense theme, a reminder that later today, the CEO of Thales, the French aerospace and defense systems maker, will speak to our colleagues over in the States. You can watch that exclusive interview just after 4:30 p.m. UK time. Guy.
So in light of all of this, let's talk about something that is emerging and beginning to emerge a little bit over the last few days. So Donald Trump's rapprochement, call it what you will, with Vladimir Putin. Investors are now trying to figure out whether or not there is a tradable story of this, i.e. whether Russian markets will open to the West. It is the topic of today's Big Take, and Bloomberg's Tony Halpin, who leads our Russia economy and government coverage, joins us now to discuss. Good morning.
Morning.
How speculative, nascent is what we're talking about here? How early in the process are we in people thinking about how to reorganise Russia being part of an economy that it's not been part of for a really long time?
Yes, I think what investment companies and traders are discovering from clients is a kind of spike in interest to try and get hold of Russian assets in some way on the anticipation that if there is a deal, sanctions might be eased or lifted. But it's still a very early and risky bet because we just don't know how these talks are going to pan out in the end and what the final state of any settlement would look like. But clearly, there's hundreds of billions of dollars at stake in terms of assets and investment opportunities and trade. So people are willing to make this risky bet on the anticipation that they may make big profits.
That's really interesting. So who is willing to make that bet then, Tony, when we're thinking about sanctions still being in place? I mean, even US sanctions, for all the talk, US sanctions are still in place, and there's even been talk recently of, well, we could put those sanctions up if Russia doesn't do what we want them to do. In Europe, there's been no suggestion yet that sanctions are going to be rolled back. In fact, we saw some expulsions from Russia, Brits expelled from Russia, and then Britain expelling some Russians. You know, things are not looking as if they're getting closer between Europe and Russia. Doesn't it feel really quite premature?
Yes, I mean, there's a lot of risk. I mean, some of the traders we spoke to, for example, were finding interest in Middle East family offices in trying to access different Russian assets. But you've just raised one of the key issues, actually, that there might well become a divergence between the US and Europe on the question of sanctions. The US, President Trump, has a much easier route to lift sanctions. He can simply sign executive orders in many cases that lift sanctions. In Europe, you've got to get consensus of 27 countries to undo the sanctions packages that they've put together painstakingly over the last 3 years. And there's less will, I think, in Europe to lift sanctions. They are very much siding with Ukraine in this, and they've seen a shift of President Trump towards Russia and towards a position of a mediator in this war. So there is a growing divergence of view, and that may become one of the risks that traders and companies face in the future.
Can we explore that hypothetical, though, that if that sanctions relief does come from the United States, but there is that divergence from Europe as well, what does a potential rehabilitation of Russia in the global economy actually look like? Is it stunted by that view from Europe?
Yeah, I mean, I think there are two issues here. First is Russian companies and traders, what they really want above all is access to the financial markets. They want some easing of the restrictions on dollar trading, which makes it a lot easier then for companies to get paid and to buy things that they need for their own companies. So in that respect, a US easing of sanctions would be very welcome news for Russia. But on the other hand, Europe was Russia's biggest market before the war. If that remains closed to Russian companies, then they continue to look east towards China and to the global south. And that's something that some companies are becoming uncomfortable with because they just want to ease their overdependence on China. They're worried about that. So again, if there's this divergence, if the US eases dollar sanctions, that makes trade easier. If Europe keeps them, then that makes trade a bit more difficult in terms of diversifying their customer base.
And for global businesses, that makes it difficult to decide what to do, I suppose. If they have exposure in Europe and the US, they might have to comply with both varied sets of sanctions, which would become difficult. In terms of what the thinking, the thought process is around these investors who have the risk appetite to go ahead and do this kind of thing, you don't know where the money's going to go, do you, essentially? And the story makes that point, that you don't know where in the Russian economy your money ends up, perhaps.
Right. I mean, there's big reputational risk, for example. I mean, you have to remember that Russia is still the country that began this war. Hundreds of thousands of people have been killed or wounded. Millions have been turned into refugees. You know, this is a reputational issue for a lot of companies with stockholders. So that's a question which they have to wrestle with. The flip side of that is that Russia isn't necessarily going to be as welcoming to Western multinationals coming back into their market as they were before, because there's a lot of resentment about the way companies left the market. While they've been away, other companies, particularly from China, have filled the domestic demand. So it's not as easy as simply opening the door and expecting people to welcome you with open arms. I think there's going to be a lot of friction. OK,
Tony, thank you so much. Thanks for bringing us that big take story. And I can see it in written form and also an audio version, of course, a podcast to go alongside it on the Bloomberg terminal and on the Bloomberg website. Thanks to Tony Halpin for bringing us the details. Coming up on the programme, we'll get back to the banking story in Europe. Deutsche Bank bonuses rise to a decade high, driven by a surge in deals and trading. More on that next. This is Bloomberg.
Welcome back to Thursday morning. What's happening out there? Well, actually, the equity story is a little bit more positive, you could argue, than it was a little while ago. We are coming back off the lows. You've still got pretty negative breadth, though. You've got, in the Stock 600, 226 stocks up, down 364. That was a 400 number not that long ago. The trucking sector is actually under a little bit of pressure. This appears to be based on the idea that the US is changing some EPA rules, which is going to ripple across into the investments that some of these big truck companies have made. That's being taken as a negative. On the upside, you've got a bunch of defence stocks that are doing reasonably well. Some of the pharma stocks are doing reasonably well as well. But Europe is off its lows, but not by much. The stock 600 is up by 0.05%.
Excellent, excellent. It's a day where we take stock, perhaps, waiting for the big stream of news flow, which we know is coming. We know it's coming.
Deep breaths.
Yeah, deep breaths, exactly. We've had some news flow surrounding the banking sector in Europe, so let's get to that. Deutsche Bank bonuses rise to a decade high as Germany's largest lender increased its bonus pool to €2.5 billion. That's a 20% increase from last year. For more, we're joined by Bloomberg's Jenny Serrain, who tracks, of course, the banking sector for us, the financial services sector here in London. Jenny, let's... Well, what is driving this? Earlier, I was talking about how banks over the last decade, they did quite well for a lot of years on those net interest margins. But this is not really about that. This is about traders. This is about deal making.
Yeah, no, I think that's exactly right. So last year, sort of towards more the end of last year, as it kind of became clear that Trump was going to be in office and there was all this enthusiasm, we saw a real pickup in both capital markets and deal making activity. And that's what you see coming through here today. And I also think a lot of these banks kind of have to think strategically about this year. And so knowing that they're likely to still see a lot of that same activity, they need to kind of keep these people well paid, keep them in seat, make sure they're there so that they can kind of, take their slice of this very fast-growing market.
Would this number be as high if London hadn't changed its bonus rules recently?
It's an interesting question. We're still kind of seeing that play out. So, yes, so now in London, banks can pay their folks. It used to be that they were capped at paying it, 2x their base salary. Now they can pay it more. The European banks haven't moved as quickly to do that. But obviously, if your competitors down the street have given their folks really big increases, you're kind of under pressure to do the same. And so I think we are seeing a little bit of that, and it'll be interesting, especially, once we kind of have a couple more years under our belts to see how much actually folks are getting paid more.
Is Deutsche Bank the tone setter here for some of its peers?
I think a lot of these banks have been making similar moves, and I do think sort of they all have to move in tandem on this. One can't pay a lot because they'll just get all the talent, and so they kind of move in lockstep generally. Deutsche Bank did have products, though, last year that performed really well. So the fact that they're huge in fixed income, they're a really big DCM house, those are products that did really well, and so that's a place that will have a bonus pool that benefits more than a place that's maybe more focused on equities, which is still a little bit on its back foot. So I think they're in a good place for the products that they have, and I think generally bankers are feeling pretty good about themselves this month.
A very well-followed story, I'm sure. Jenny, great to see you this morning. Thank you very much indeed for updating us, Jenny Serrain, on what is happening with the banker bonus pool story. Let's talk about what is coming up in terms of the day, but there's a busy day.
It's a busy day. It is, certainly. I feel like there's a lot of data on both sides of the Atlantic to keep an eye on. At 10 a.m. UK time, Eurozone industrial production data is going to be hitting the wire. Then, as promised, the focus over in the States. We got the CPI number yesterday. We'll see if we get the PPI numbers in line today or a major divergence in terms of whether or not they're pricing in some sort of front-running of tariffs in the States. Jobless claims as well, certainly in focus around the concerns around the labor market in the States. And then on the geopolitical front, two things to watch. The EU-South Africa summit, where Ursula von der Leyen will be attending. But then over in the States, Mark Rutte, the Secretary General over at NATO, meeting Donald Trump. So some interesting conversations on both fronts.
OK, so he's maybe thinking more about, President Trump this is, maybe thinking more about Ukraine and thinking about defence today rather than tariffs, but we're always braced for more tariff news flow. And with that in mind, the person that every country seems to want to get a meeting with right now, the Commerce Secretary in the United States, Howard Lutnick, we are going to have an interview with the US Commerce Secretary at midday London time. That is on Bloomberg Surveillance, so stay with us for that one. Let's bring into the conversation Valerie Teitel, who is always on tariff watch and watching for all of the data today. The data which follows on from CPI yesterday. We go more to the factory side of things and PPI today. What story are we expecting to be able to tell around inflation?
Well, it's a fairly nerdy inflation story today. A lot of the components that came in soft in CPI yesterday are not ones that feed into PCE. So now our eyes are very much on this PPI print. Will we see some of those components that feed into PCE, such as airfares and healthcare? Will we see those come in soft? And will that maybe underscore the market reaction yesterday to CPI? We see maybe another boost to the equity market, maybe see front-end treasuries rally rally as well, because we are getting close to that Fed meeting. Remember, it's next week. Perhaps today's print will cement whether they want to keep that door open for a May cut or not.
So the market's looking for an excuse to buy. The pod shops apparently have been a factor in the downturn. Maybe this is all technical, and that's what we need to look at. But people are looking for a reason. Are we seeing one yet?
We're always looking for a reason to be optimistic, Guy. Yeah,
in equities.
In the equity market. J.P. Morgan with a note out calling for buying the dip, saying that the worst is over for the U.S. stock market. And the reason that they did that, reason that they're saying that is interesting. As you mentioned, they are seeing more of the equity retracement in the last few weeks due to deleveraging from hedge funds. And that's been mirrored in a lot of reports that we've had recently. You know, Citadel, Millennium seem to have had, terrible February, one of the worst in a few years for those hedge funds, which are known to perform quite well during volatile times. So, yes, if that was just deleveraging going on, hey, maybe risk on today. But it seems like the equity market for now has been reacting very swiftly and very volatile to any new news on the tariff front. And with that, guys, I think the market is going to be paying attention to what we hear from Howard Lutnick in a few hours' time when he joins us on Bloomberg TV.
Yeah, it's a fascinating one. We know, of course, a lot of the smart money was already overly concentrated and very crowded in the tech trade anyway, which has been driving a good chunk of the losses. But does that mean that tech is no longer the hedge in the face of deficit news, trade news, tariff news? What's the hedge here?
Yeah, that's a good question. I think, a lot has been said that gold has been the favorite hedge. It has underperformed of late. But, I guess it goes back to, what exactly are we hedging for? Are we hedging against tariffs, or are we hedging against the possibility we don't see these tax cuts come as soon as we come from? Those are going to be two different things you're going to look out for. I, for one, it maybe is mirrored with the market. We want to hear less about tariffs from the Trump administration. We want to hear more about the tax cuts and the more pushing to deregulation. With that, guys, we know that Trump is likely to push for a new bank Fed cop sometimes later today as well.
It's interesting on that note. Yeah, we want to hear more about the tax cuts, perhaps, but the media were pushed out of that meeting with Wall Street and executives from business just days ago that happened in Washington. So we get all the public commentary, which is a lot of it around tariffs, and we didn't get to hear all of. We've had reporting, of course, from people in the room, but.
The tax cut story is bogged down, which is really interesting. They're really struggling, the Republicans, to push this through. You've also got the shutdown story, which you've got to fold. The buy the dip, does that get affected by a shutdown? Monday morning we come in, government's not working.
These things always go down to the 11th hour. I think the market's kind of tired of dealing with it. Obviously, it's something you have to keep into account if you want to buy the dip. But maybe this retracement today is a good opportunity to get in.
Do you want to take that risk into the weekend when the potential government shutdown is sitting there?
Yeah. And with it so much on the Democrats' side, the assumption always is they maybe don't have the nerve quite, because maybe their worldview is more favourable of government spending, don't have it in them to sort of send us really over the edge with a shutdown.
Yeah, absolutely. And certainly something that's weighing on those futures stories as well. Futures in states at least down about 0.5%, but a lot of that concentrated in the NASDAQ as well. Bloomberg's Valerie Titel walking us through some of the dynamics for the next 24 hours in these markets. Now, of course, we have talked plenty about the tariff story, plenty about the defense story. If you haven't heard enough already, Bloomberg TV does have an interview with Howard Lutnick, so we'll see what he has to say on that tariff front. That does it for the opening trade. The brief is up next. Stick with us. This is Bloomberg.